Hello, everyone. My name is Nathan Corey here at Richardson Capital Management, and I'm joined today by Dan Brown, our Director of Investment Management. And we are here today with the Economic and Investment Update for the month of August 2025. Well, Dan, as disappointing as it might be to be coming into the last days of summer here, one thing that's hard to be disappointed in is the recent performance of the financial markets. In August, we saw another strong month of positive returns on both the stocks and fixed income side. And in fact, August marked the fourth consecutive month of positive performance in the stock market after a much bumpier start to the year. Before we drill a little bit deeper on some of the key factors behind that performance, do you want to just give a real brief recap on what we saw overall for the month?
Sure. So for the stock market, again, as you mentioned, fourth consecutive month of higher returns. And what we saw is broad participation, nearly all sectors positive for the month. And the catalyst behind that, we'll get into a little bit in a little bit here, but we saw strong indications from the Federal Reserve that they could cut interest rates, and bigger picture, corporate earnings continue to remain strong. So we wrapped up second quarter earnings here in August. On the fixed income side of the ledger, bond returns were very solid for the month of August. And again, reasons for that. Interest rates declined very slightly. And then broader, bigger picture is corporate credit health remains very strong. So very little in the way of defaults on the fixed income side. So again, very strong returns all around in the month of August.
And Dan, as you noted, one of the more significant factors impacting the financial markets is interest rates. And while the financial press seems to really focus on, the timing and the magnitude of future rate cuts, it's important that we think through some of the underlying factors behind those rate cuts, things like employment reports, inflation data, impact of tariffs, that kind of thing. What do we see specifically in the month of August that would be a big factor there?
Yeah, the biggest factor was the fact that with the July jobs report that was reported the first week of August, we saw job growth slow quite a bit. And that's been the trend for a while now. So the August report that we saw for the month of July came in quite a bit less than expectations.
Mhm.
And maybe the thing that really caught investors' attention was the revisions for the prior 2 months was very negative. So it detracted about 260,000 jobs from the prior 2 months. So that was fairly negative, and that led to a little change from the Federal Reserve later in the month. So we saw a very important speech from Fed Chairman Jerome Powell later in the month, and he cited the weakening labor market conditions. And the way that he worded his speech, investors took that to mean that they're leaning towards an interest rate cut at the next meeting in September. So the way that this is priced into the market, it's about an 85% probability that we'll see an interest rate cut at the September meeting. And just to reflect on that historically, when odds are that high, the Fed rarely disappoints.
Sure.
So I think it's pretty reasonable to expect them to cut interest rates in the month of September, probably by a quarter of a point. And just to recap where the Fed has been for the last year or so, they've been on pause pretty much all year. The last interest rate we cut that we saw was in the month of December.
Mhm.
And ever since then, the Fed has cited that they want to be on pause or hold just because they're worried about the effects of tariffs leading to higher inflation.
Right.
We really haven't seen that higher level of inflation kick in. And the Fed seems to be softening its stance or its outlook on inflation. And there was one important quote that I want to read from Jerome Powell's speech. And that quote is, "With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance." So that's what investors reacted to take that as a positive cue that the Fed is ready to begin cutting interest rates again. And I just want to talk about the first part of that sentence where he says, with policy in restrictive territory.
Mhm.
They've been saying that all year, and not just Fed Chairman Powell, but other Fed members. So basically, the Fed is telling us that they think monetary policy is restrictive. So it's just a matter of timing of when they're going to make a cut or do further cuts. And we think the time is right with the labor market weakening, that September makes sense for another cut, probably a quarter of a point.
And Dan, circling back to equities in particular, and here in the U.S., as we see the positive performance in the stock market, a key question on the mind of investors is obviously, do the earnings justify the price? And in the month of August, we kind of saw the tail end of the earnings releases from companies and their guidance going forward. What do we see kind of through that earnings season, and how do we feel about that?
Yeah, we've seen a pretty consistent trend now of numerous quarters where companies not only beat on earnings, they beat on revenues also. And one thing that we've been focused on the past number of quarters internally here, just to take our cue for the outlook for the financial market and specifically stocks, is how much are they beating by when they report earnings. So the chart that we're showing here is something that we've titled, second quarter surprise factors. So surprise meaning how much did they beat expectations by? And we're looking at both earnings and revenues, and we're looking at this both at the broad level for the overall S&P 500 index and every economic sector, all 11 economic sectors. So just starting with revenues real quick on the right-hand side of this graph, we're seeing that all 11 sectors, beat expectations by a pretty decent margin for revenues. And then if we look at earnings, we can see that the overall S&P 500 had a surprise factor of about 8%. And we see that basically 10 of 11 economic sectors surprised positively. So if there's one thing that we know about stocks and what they like and what investors like is when they beat expectations by a pretty wide margin. And that's what we saw again here in the second quarter. And again, we've seen this now for numerous quarters in a row. And one thing we talked about last month is reasons for this is the fact that, again, overall earnings tend to be pretty positive, and that gives corporations excess cash. And one use of that excess cash is them doing stock buybacks.
Mm-hmm.
So that's one factor that we think that has led to the positive surprises. And we think that'll continue for the next couple quarters here. So I guess the message is, don't fade the equity markets here. That's one reason why we feel we still have a positive outlook on the stock market, despite the fact that valuations are historically high.
So, Dan, as we put all those factors together and kind of look at the big picture going forward, it seems like, despite a relatively weak jobs report, we've got some, brighter things coming, hopefully, from the Federal Reserve on interest rate policy, strong corporate earnings, and kind of feeling pretty good about things going into the end of the year. Would you agree?
Yes, absolutely. As we talked about, we think the Federal Reserve is poised to begin cutting interest rates again as early as September. So it wouldn't be, ridiculous to think that the Fed could cut rates by a half a point yet this year. So maybe a quarter point in September, quarter point in December. And then as we look out to 2026, we would think, maybe 2 to 3 more rate cuts is appropriate. Again, the Fed admits that monetary policy is restrictive and they're just looking to get to neutral. So there's definitely more cuts in store. So, we go back to the old expression about don't fight the Fed.
Mm-hmm.
The Fed is easing policy that generally tends to be good for both stocks and bonds. And then, as we already talked about, corporate earnings remain pretty strong, and we would expect that to continue for the remainder of this year.
Well, with that, we want to thank you for watching. As always, please don't hesitate to reach out with any questions or concerns you might have. And we sincerely appreciate your continued trust and confidence.